Hi, everyone, and welcome to HealthView's Medicare 2025 Trap webinar. My name is Jeff Mustafa, and I am the CEO of HealthView, and I'm really glad to have you all with us today. At HealthView, we support general practices right across Australia, helping them optimize their revenue, cut costs, and get on top of the ever-changing landscape of Medicare, compliance, incentives, and practice management. I come from a background of business and operations, and over the years, I've worked with GP owners, practice managers, and GPs to improve the financial sustainability of general practices without compromising on the quality of care they deliver. Our clients range from solo GPs to large multi site operators, and no matter what, we've often found money is left on the table. That is where our team comes in. Through our products, Revenue Boost, Expense Hero, and Practice Maestro, we help you optimize your MBS billings, ensure that your PIPs and WIPs are fully maximized, as well as obtaining government grants, reducing your operating costs, and supporting you with end-to-end virtual practice management. This session isn't just about compliance and Medicare rules, it's about protecting your bottom line and future-proofing your practice heading into 2025. We have an absolutely stacked session today, and I'm excited to be joined by David Dahm, one of the most respected experts in our industry. By the end of today, you walk with not only a better understanding of the Medicare changes, but also concrete strategies to increase profitability and staying compliant. We're here to present you with the facts so you can make the most informed decision on your practice. So grab your note pens, stay off the emails if you can, and feel free to drop in questions in the chat. We'll try to get to a Q&A session at the end. I'll now pass you on to David Dahm. David, let's dive into it. Mind giving everyone a quick introduction?
Hi, thanks very much, Jeff and the team. Really appreciate the opportunity, the invite to present today. Basically, I'm a chartered accountant. I come from a medical family. I started my firm called Health and Life back in 1992, and we operate nationally. And I have been an ACPAL surveyor for over 10 years, as well as being able to sign not only a Bowie Dick test, but also a tax return. So I guess I work with a very vertical view of the world, not just looking at numbers. I take a real top-down and bottom-up look at issues, not only from a tax and accounting compliance, but just from a people compliance, and just making sure that, we're putting the patients, the practitioners and the practices first, so you're sustainable. So I really appreciate this opportunity. Look, there's something I want to say is there's some of the issues we're going to be covering here are pretty full on. There's a lot of detail. The idea of today is I'm giving you talking slides. You can take screenshots, take them back to your advisors. And the whole idea behind today's session is, hey, these are the questions, and asking the right questions is more important than getting the right answers. And what we have noticed, that there's a lot of low-hanging fruit opportunity that people aren't asking those questions, and we're now just sharing this, and a lot of data that I haven't made public, so it's unprecedented amount of information we're going to give you, so you can go away and make your own decisions. We're not asking people to come and pick up the phone and become a client. We just are here to hopefully educate everyone more about themselves, their practices, how they run, and key things to look for with, and together with Jeff and his team that can be follow up afterwards. So let's move on and get into the presentation. And so I'm just going to try and move my screen here to the next slide. And we're a bit stuck. Here we go. While I'm just waiting for my screen to go to the next slide, we are going to be talking about three key areas. For some strange reason, the screen is not moving. Here we go. My apologies. Here we go. Here we go. This is the first. This is a summary. What we're going to be talking about. It's called "Make It, Keep It, and Hide It." How to make money in healthcare that's legal and ethical. Keep it. Basically, don't pay more money to the taxman than you have to, and hide it. Look, there are a whole lot of problems when you're running a medical practice from a medico-legal point of view, and even from insolvency and cash flow. They're both practitioners and the practices need to be really mindful of, particularly in this new environment that we're entering. And hopefully at the end of the session, you'll see some key action points and next steps moving forward on what you can do next to make, at least check that you're doing the right things. And if there are things that you need to do, you can move forward. If we go to the next slide, that'd be great. So I'm having a bit of a problem with my controls here. They don't seem to be moving. They were before. Here we go. When we talk about practice ownership, sorry, there's a bit of a scribble there for some strange reason. When we talk about practice ownership, at the end of the day, why you own a practice at the end of the day is so you can hopefully sell it one day to another practitioner. Now, a lot of people say people aren't interested in ownership. Well, they are when they're actually aware of the numbers that, there's an opportunity to not just eat what you kill, but earn while you sleep. And if you can't explain that to people, people are just working for a percentage, and that's not very exciting, and they don't have a control of their own destiny. So I'm very keen on obviously the next generation of doctors and people who are like-minded non-doctors owning practices. So therefore you've got real continuity. Unless you have people wanting to own practices, then really we have a major crisis. Nobody wants to join the Titanic if everybody wants to basically leave and resign. So hopefully this is an example of one of our clients. They had problems in recruitment and retention. They went from 3 to 17 doctors under 3 years and made the BRW fastest 100. They're ordinary people like the rest of us, but they followed a key vision, key strategies, and they executed, and that's how they got the results. And in fact, I only met them about 3 years later at the awards. So it is possible. It's not a secret that we're showing today. We're showing you tools and solutions that actually work and that are tax compliant, so you don't have to worry about those other things that people typically worry about. So we'll try now go to the next slide, if we can, and so I'm having a problem with my controls here. These are the key mistakes that we see people make, and number one is they actually find out that that they keep assuming, oh, my accountant's on it, or my practice manager's on it, or the director's on it, and assumption is the enemy. Unless there's screenshot proof that something's happened, you just got to assume it didn't. And so we're very big, we use things like Google Chat and screenshots to show things that happen. Little things can make big differences, and execution is really the key. You can have great ideas, but as they say, it's 99% is about execution. One of the major things we see that are causing problems that people don't know their numbers. So financial literacy is a key problem. And the importance of just understanding, well, when money's coming in, expenses are going out, when are you making bank, and then when are you making profits to pay off the loans? And today, hopefully, we're going to demystify that for people so you can easily understand and compare and see how you're going to national benchmarks. Recruitment retention, have a strategy where we call it from employee to entrepreneur, and then basically when practitioners join you, particularly registrars that we work a lot with, they can see an absolute future, and they feel they've got some skin in the game, and you'll get a lot more workforce ability. There's nothing more inspiring seeing young doctors taking up ownership. They attract other young doctors. Just assuming they're not interested is the biggest mistake we see people make. The other thing that we see, and this is mainly because of the media, people using separate bank accounts because of this payroll tax issue, and taking out of context, judges throwaway comment that, you won't have a payroll tax problem if you open up another bank account. We're seeing significant cash flow problems and complexities with fraud and error and mistakes when you're paying doctors on a percentage. That these are sort of some new challenges that have come up, and there is a way to have central banking and not have those problems and be payroll and income tax compliant moving forward. But the biggest problem we see is proper classification, and we're going to be talking about this, about, are your practitioners, are they contractors or independent practitioners, which are contractors that are employee-like, or are they true tenant doctors where they don't attract all these tax and problems we're going to be talking about today? And it's just not enough to call yourself a tenant doctor and you've got no problems. the courts are looking at evidence and proof, and I've got my friend here, Lucas from Hamilton Bailey, who helps us a lot with constructing these agreements. He's online. If people have got particular technical questions on those in the chat, he might be able to help you. We can talk to you guys later if need be. So we're going to try and demystify some of these issues. We'll go to the next slide if we can. Thanks. And get down to some nitty-gritty detail. I'm going to move us fairly quickly. We're here mainly because of this new incentive, this 8.5 billion Medicare incentives. If you're 100% bulk bill, you'll get a 12. You're going to get an increase in your PIP, and that's going to be shared. I don't mean to go into that detail. I think a lot of you have read the information that's available, and the Medicare has provided some more frequently asked questions. The real issue that's on everybody's mind is, if I tell a doctor to bill or not to bulk bill, then am I going to have a payroll tax, an income tax, a superannuation problem, a work cover problem, and even a fair work problem, because now I'm telling what to do? And the answer simply is yeah. If you're sitting there and you're governing how they bill and what to bill and when to bill, you've got a big problem. A big tax problem that can be up to $250,000 per full-time equivalent GP. Now, there are ways to legally and ethically get around that particular issue, and that's what we'll be talking about. Let's go to our next slide. And the other issue is that if you've got great ideas about improving revenue and billing, there's a new 2025 audit compliance requirement here that they are looking at the bigger corporate practices, and they're doing a lot of things called like guilt by association stuff. So if you're finding a particular practitioner, has been, nicked for maybe, passing the speed limit and over servicing, it does actually throw some shade on everybody else co-located at that location. They are clearly looking at amping up and reviewing these sorts of opportunistic billing. So this is obviously, it doesn't matter what great ideas you have to have your eye on this, that this is an issue. And plus, obviously, double billing with duplicate payments seems to be the other big issue coming up. I think their technology improved, and there's been some very interesting AI that we see is going on where they're able to get and look at some very granular transactions. And it's been quite interesting that Medicare, or at least their billing department, seems to have caught up. We'll go to the next slide. So this is the whole thing. You can make money, but compliance is the big issue. But the biggest one in the room is this whole thing, and then particularly when this $8.5 billion announcement was made, our key concern is, can practices really afford to go to 100% bulk billing? And what are the implications? Are you then suddenly doing a couple of things here that you're tanking your bottom line? And here, when we did it, we looked at particularly the profile of our clients, and we've been doing this, like I said, for over 30 years. We have a curated database, and we looked at it and we said, look, at the moment, if you're being 80% bulk billing, 70-30 split, you're making around about $1.33, profit per patient. Your break-even point, that means, to make bank, you're not even making a profit, you need 1 FTE. So if your practice falls in that sort of billing profile, that's where you sit. But overnight, if you go into November 2025 and you suddenly do 100% bulk billing, what we've seen when we've done our projections, and giving up that little gap makes a big difference. What you'll actually see is that you'll make a $7.07 loss per patient, and your break-even point is you're going to need 5 to 6 FTEs in order to keep your doors open. So, and the reason is because you've got additional costs, particularly staffing costs to meet the extra volume, and that's on the presumption, the assumption you can find the additional doctors who are probably more focused on the work lifestyle aspect, that they're even prepared to do the extra hours. So there's some other more practical issues. It's fine to say, yep, go to 100%, but the reality is the numbers don't add up, and the bigger one is really is a workforce going to actually step up and say, yep, I'm happy to work, at a bulk at these bulk billing rates, and some of them might feel quite offended and devalued with the request. So this is they're throwing the cat amongst the pigeons for practice managers to try and deal and wrestle with this issue with their practitioners. But for a lot of you, you probably already know that this might not be the best idea, but you have no choice but to consider it. And for some practices where they're already bulk billing, this is not going to be too much, too much of a problem, and it's probably more of an opportunity for the larger practices that have like 12 FTEs moving forward. We'll Go to the next slide, thanks. And what we're going to look at here is um, just going a little bit underneath and looking at some specific numbers and assumptions. We made the assumption that on average, and we do know it's roughly about 5,000 patients services per FTE GP exists, and the government's modelling was, well, you're going to move from 5,000 to 6,000, probably a 20% increase in the number of patients. So these are some assumptions based on their modelling. We've looked at our evidence-based curated benchmarks, and then we've basically done some projections based on what the government's assumptions are, and looked at what really the impact is on the average fee per patient, and there's about a 20% drop there. What's the average gap? And we're looking at the average gap across all services, not some services you've got a large gap and not others. And we're saying, look, if you're getting on average a $20.76 gap, that's going to go to zero. And what the impact's going to be is your overheads are going to go up from $36 to $38, a patient. It's about a 6% increase, and includes an estimate for payroll tax and super. But the real impact here is that, and this people go, well, hang on, Dave, you said I was making a profit. The actual loss you're actually making, even when you've got this 80% private billing, is what practices don't realize. You're actually subsidizing your practitioners to the tune of $5.44 per patient. And that subsidy is going to increase to $13.97 per patient. And the rationale is, well, how does that work, David? That means we'd be all bankrupt. Yes, you would be if it wasn't for pathology rents for many practices, and also for PIPs, which basically attempts to bridge the gap. So that's the only reason why you're keeping your doors open. Otherwise, if you lose the PEP, if you're worried about pathology and there's been a bit of a contraction in how much you're prepared to pay, what you're going to find, there's going to be a lot of what are called subsidy pressure, and you're either going to have to increase gaps to the patient to the front desk, or you're going to have to look at increasing the percentage you're charging the doctors. Instead of it saying a 70-30 split, it might be 65-35. So this has got a rapid impact, a big impact on your practice. So, and the problem is once you go down this path of 100% bulk billing, it's really hard to pull back. It does change the culture and the feeling of the practice and the way patients receive you. So this is a very, very important strategic decision you need to take, and needs to be a conscious one. We'll go to the next slide, and we'll just talk about trying to create some financial awareness. We really looked at, and when we talk about full-time equivalent, it means 38 hours, and we looked at the patient fees earned over the last few years. And obviously we've had this whole COVID thing happen, and there's been a bit of a big boom in services. And we've also seen, and we've seen revenues go up, but things are starting to sort of normalize. And particularly when what we saw was the inflation wasn't really keeping up, in terms of with costs, that a lot of practices went into private billing. So a lot of practitioners said, well, I can make the same amount of money, but guess what? I don't have to work as much with gaps. So what we're actually seeing is turnover per FTE is actually dropping, because basically having a gap, even if it's 80% are still bulk billed, has a significant impact on the return back to the practitioner and maybe their interest in working. So a lot of this is just, doctors saying, look, it's work-life balance. I'm burnt out due to COVID. The emergency's over, and people are just getting back to saying, well, I will work to a lifestyle that meets my living costs. And a lot of practices have been offering higher service fees to retain practitioners, so they're not having to work as much. So there's a bit of a double-edged sword in there. What we have seen is that service entity revenue has dropped from 328,000 per FTE to 246. So for example, if you've got 10 FTEs, you can easily do that at the back of an envelope, and you multiply it by that number. That should tell you SIPs, PIPs, and service fees, what is the gross income that you're making from all your practitioners and all your other alternate sources of income, to then offset against your costs. And we'll go to the next slide. So hopefully that little example gives you an idea how to basically do your calculations. And we're happy to be challenged if people say it's right or wrong, but this is obviously from a curated client base here. But that's a really quick and dirty way to really work out, well, what is the revenue you're generating from all your sources of income. If we go to the next slide. And what we will really focus on here is the how do you work out estimated expenses? And I've just done some key ones that might be of interest here. And we've got a situation here that, look, if you look at your wages, the wages have actually dropped, and that's because we treat wages, we think, are variable, mainly because we think that every time you take on a new doctor, you take on a new receptionist, and that's a pretty big overhead, and teams seems to move up and down with obviously the foot traffic, bumps on seats, and the number of practitioners. And certainly what we're seeing here is that, you can estimate, look, this is, if you've got 10 FTE GPs, this is what your wages bill looks like, obviously excluding super here. And that's what you budget per month. So I'm just giving people some ideas on how to work back some numbers, but we're going to go back to the high level numbers, some key ones. We'll go to the next slide if we can, thanks. And we'll talk about profitability. This is, they say, revenue is vanity, and, profits are sanity, and then they say cash flow is reality. Now, to me, the most important number here is the profit margin. I don't care who you are, whether you've got a service entity, a tenant doctor, a contractor arrangement, whatever you want to call yourself, or a medical center arrangement. The profit margin, this is what you've got left over so you can pay off loans and debt. Now, I know this is quite controversial, everybody says, but nobody's making more than a 2% or a 3% operating profit margin. All I know is on my client base, and they are fairly, they do know their numbers and they do carefully watch them. Their profit margins are sitting here, they're quite high, but they are starting to taper off. It's down by 3.8% here, mainly because of, doctors not working as much. And, what we are seeing though is a normalization of costs here. So if you look at your service entity expenses here, they've gone back to more normal rates here, but it's quite a significant drop, simply because more private billing, they're just incurring less costs. And so if you really want to know what is your profit that you make per GP, or at least what's attainable, it means it's around about 63,000 per annum per FTE. So every time you talk to a GP and you're trying to get them on board, if they're working full time, that's the profit. That's earn what you can while you sleep income that you're generating by bringing in an additional practitioner. And that gets only higher because you've got fixed costs, and those fixed costs don't increase over time, and therefore that hits the bottom line, which is important in terms of A, paying off loans, and B, if somebody wants to buy your business, your practice value goes up. And people are more likely to buy a business that's making a profit than one that's making a loss. Otherwise, you look and you sound like the Titanic. Nobody wants to join a business that's making a loss. So when people say, how much is my business worth? It's not your turnover. It's not how many FTE GPs you've got. It's basically, do you have a profit? What is your profit margin? And is that sustainable without the key owners being in play? So let's go to the next slide. And this hopefully kind of gives people some sense of understanding of how these things work. How can you quickly raise revenue without increasing the service fees that you might charge, or the percentages increasing, against your practitioners? A simple example here is medical consumables. Patients are more likely to pay for something that is tangible than just advice. It's like, I speak to my lawyer and accountant, and all I'm doing is paying for advice. And so really what we're doing here is we're saying, look, you can pay 9,000, you can make 91,000 per annum if you charge for consumables in the practice. And so as a result, you can see there is an opportunity to raise revenue by just charging dollar for dollar whatever medical fees that you incur. So anyway, so that's another example. We'll go to, and something else that's important to note, that dressing and bandages are basically going to be paid for by the government, or at least subsidised the patients in May 2025. So there is an opportunity to start charging for that. Now, my best advice is get the practitioner bill for it, so it's becoming GST free when it's used on site, and you can charge a 95 or 100% service fee. Depends if you want to give the practitioner a look in to make sure that those consumers are billed. So therefore, that's a really easy way to put an extra $100,000 on your bottom line. We'll go to the next slide. We have a program called Doctors Pay Calculator, and our clients use it. It's actually available on a doctor's mobile phone, and basically it shows them, look, this is how they're billing. Some of the easiest things to do is to make them financially aware and literate. So if you're trying to encourage them to improve sessions, or if they think they've had a bad month, there's nothing more there's nothing more that we've seen they enjoy is when they can easily see, oh, I did well this month, or I did poorly, or I need to improve. And this is all basically tax reconciled data to their service agreements, to their BAS and tax returns. So it's something that really they can trust the information, because there's too much information that's piecemeal, only shows part of the story and not the whole story. And that's really, really important when you're trying to motivate doctors and say, look, we're going to make your life easier with less red tape, but also here's your numbers. So then when you get up in the morning, you can work out whether you need to work more or less. Giving them some sort of way 24/7, they've got access to their own information is really critical motivator, and letting them know, look, this is how you're traveling. We'll go to the next slide. So it's not enough to just say you're going to make money from these things, but it's really important then when you have practitioners, if you've got them, that you have a proper agreement, a proper service agreement. People use that word loosely, but we call this a tenant doctor agreement. So it actually shows that they've actually got a floor plan, and they pretty much get charged for, the services they use. It's a user pay system. So if a doctor's late, I've got clients who will actually say to them, look, we're going to increase our service fees if you're always late, or we have to cancel bookings. So that's not influence, that's just charging on a user pay basis. And it's a subtle way. You can make a subtle threat, but it's a way to encourage people to maybe, maybe be more reflective. It's a much fairer way to actually bill for service fees. No doctor likes basically underwriting another doctor who basically is costing, the group more money. And so this particular service agreement, you should screenshot it. If you've got service agreement, you spend a lot of money on lawyers. If you don't want to have a payroll tax problem, we've actually used this and won audits on this. This is probably the best way to move forward, that you've got some key clauses here on how fees are charged. And this new Uber decision that's coming in is going to be quite important. And we'll talk about that shortly. So we'll move on to the next point here. It's fine to increase service fees, but you need their permission. And what you can do is you can have a whole range of types of fees with your practitioners. You can say, look, we'll give you a discount if you do 10 sessions instead of 5. We can give you an incentive of 20% if you're basically starting out, and then we'll increase it back to 35 or 40. We've got clients who have, particularly with overseas doctors, recruitment retention recruitment fee that's not a restraint fee, saying, look, if you do leave and go down the road in the next 5 weeks or 5 months, we will charge you a $50,000 fee. Other clients are using it to basically bill some of the apps that you've got, and Lucas, the lawyer, will tell you, look, that's really, really important. And there are other ways you could offset other costs. So then it looks like that these tenant doctors really own the business and they're making their own decisions. And this is becoming quite important, not just from just trying to recoup some of your costs, but it's really important doctors are seen to be paying for these services, and it's not all being paid by, dare I say, the medical centre or the practice. If you're trying to establish you do have true tenant doctors, and we'll talk about that very shortly. We'll keep moving forward. And these are ways you can get revenue. How people basically are more likely, and we've found this as practitioners, if you get rid of their red tape and make their life easier. And so we basically have these reports that give them the BAS and income tax extract summaries every quarter and at the end of the year, with all their tax invoices on their phones that they can download and forward to their accountants. These things, practitioners, believe it or not, are prepared to pay for things that they do value, and this is something that is a bit of an embuggerment. And what's really important, there is a proper bank reconciliation process, which has become a big issue now. You can't just rely on just, oh, well, Praxoff says that the money's received as X or Y or best practice. It has to be reconciled to bank. It needs to be done properly. The government has introduced new rules with tax agents saying if you're not doing it, you cannot rely on these third-party software programs, which I'll talk about next. We'll keep moving forward, but these are just examples of how you could basically add value and give yourself a competitive edge. So if we can go to the next slide, that'd be great. There are certain fees you can have, and there's just more examples here. You can have different rates for different types of services, workers' comp, or charging for consumers. Now, all of the good news about all of this stuff can now be automated. It's not as difficult as it used to be. No messy spreadsheets, talks to Xero, does all the tax invoice. A lot of these things that used to be quite complicated and convoluted can now be done fairly easily. A 10 doctor practice doing pays within a half an hour. And as long as you haven't got any complicated arrangements, and doing it by the book. So this is becoming really important to be open and transparent and accurate with your information. That's what creates and breeds trust. We'll keep moving forward on that point. Now let's we're going to be talking about some compliance issues. These are ways that you can maybe generate more income. If we can go to the next slide, that'd be great. And one thing that you would have seen is a big headline that came out in Queensland. This is about in 2023 that, Cameron Dick, the Queensland Treasurer, told Parliament, if you've got tenant doctors, you don't have to worry about payroll tax. That still holds true, not only in Queensland, but around Australia. When you look at the case law, not just the rulings, that if you have a true tenant doctor arrangement and you're an administrative business, and the Queensland ruling was excellent in actually highlighting this point, which sadly not the other states picked up on, because I guess, if they give half the information, everybody feels like they're liable for payroll tax versus volunteering more. The fact is, the case law does support the fact that if you have a genuine tenant doctor arrangement, it does not attract any additional payroll tax. You don't have to apply for exemptions. You don't have to volunteer this stuff to the government that could be shared with the ATO, from your local state office. So this becomes really important in being clear. How do you identify your working relationships with your practitioners? Let's move forward to the next slide. And I'm going to kind of start digging deep, because this is the biggest opportunity and also the biggest mistake we're seeing happening in Australia. I have seen, and I've been doing this for a long time, I actually did a lot of this work when I introduced, I was asked to write a piece, and I think we did the first GST handbook in Australia. I think it was with Medical Observer Australian Doctor at the time when the GST was first introduced. So I was flying around by AstraZeneca advisors, and I met a lot of practice and looked at a lot of their structures. And a lot of them had what we call an administrative business structure, which is payroll tax free and doesn't have all these contractor problems. And but over time, a lot of these businesses have accidentally mischaracterized themselves as medical businesses because they started calling themselves a medical center. And they weren't sharing, and they were looking like they're having revenue sharing models, which is exactly where the payroll tax office started to raise a bit of an eyebrow. And they sort of were departing away from this sort of back office cost sharing arrangement when a group of solo practitioners would co-locate, a bit like Westfield and having, Woolworths and Coles co-locating. They started, Westfield started selling tomatoes basically, which kind of blurred the lines. And that's where advertising and marketing and all these things became quite important. And that's what's led to a number of prosecutions. So we'll move forward. If you can get your model to the correct administrative business model, then you don't have to worry about a lot of the other things I'm about to discuss and share with you. And one of the things I worked out is that if you have a cost sharing model, and this is something that happened in 1978, and this has been good federal case law, it started with a group of accountants called the Phillips case, you can get a group of professionals to share costs. And in this case, it was a percentage of gross fees was used, and I was involved in that ruling in 2008 with the Australian Tax Office when the AMA called me in to give some feedback. And in fact, your APRA registrations, the declarations that each of the practitioners make, they actually say, well, if you are operating under a cost sharing arrangement, you need to declare it and which practitioners are co-located. So one of the first places that people are going to look if you're saying you've got a tenant doctor arrangement is they're going to be able to cross-validate that information on these annual declarations. So it's really important that if your doctors are saying they're tenant doctors, it's not enough to put the label. Make sure you can prove it and you've got actual evidence. And one of the first places the payroll tax office and the income tax office is going to look at this, because this is going to be a pretty defining and important defining point in terms of determining whether you do or don't have a tax liability. Now we'll talk about that in the next slide. So being really clear whether you have an administrative business or a revenue business or a medical business, it's the difference between paying a lot of tax or paying no tax and not having to worry about all this additional red tape. And what I say to everyone, unless you've got a genuine tenant doctor arrangement and you get a lawyer and accountant to sign off, it doesn't have to be us, you can go from being high risk to low risk. So we'll keep moving forward. And your arrangements have to walk the talk. So it's not enough to have a clever agreement. And in fact, this Uber decision that's just come out 2 weeks ago, in fact, it's quite scary. The details of the decision are going to be coming out in the next 12 weeks. But what they're doing is they're potentially saying that judges, if you're governing the entire relationship and it's highly structured, I'm worried about accreditation here, you know what, you've got probably an employee-like arrangement, and therefore they could be deemed as employees, and that's got some huge implications, not only for payroll tax, but a whole lot of other regulators. And so the role of, and when you look at sort of the mistakes people are making, in 2004, last year, 60% of general practices volunteered they weren't payroll tax compliant, and I'm sure they had the best lawyers and the best accountants, but they all got it wrong and they volunteered themselves. And I think a lot of them probably prematurely volunteered themselves, not understanding this nuanced area of law. If we go to the next slide, I can actually show and explain exactly what I mean. So here you go. If you basically have got deemed employee like contractor arrangements, what this basically means is if you go and volunteer to the revenue office, I want a payroll tax exemption, you're potentially triggering off an ATO audit, looking at GST and saying, well, is that a real genuine business that practitioner has? And they can even risk having their ABN cancelled. So they will data share. They can be reclassified as employees, which means you've got PAYG, you've suddenly got 11.5% super from the time you'd first engaged their services. Fair Work got changed last year in February, so they're going to be deemed for for annual leave and sick leave, and then there's work cover. So this is the problem. If you just sit there and just say, oh, well, I think they're contractors and I'll just put some money away to pay for the payroll tax, that's pretty silly. So what I say is, and this Uber decision is going to crystallize this case law, and this is going to mean that a lot of these contracts that have been written, which are templated or otherwise, where the lawyers haven't gone and checked your tax returns, they haven't checked the banking arrangements, are going to be basically treated as sham. And that's pretty much where they're going with this. Now, hopefully I'm wrong. There'll be a high court appeal, but pretty much they're saying if your contracts don't walk the talk, it's like lipstick on a pig. It ain't going to save you. So we say, don't play snakes and ladders, play chess. Have a tenant doctor arrangement, have an administration business. And if you do that, the main reason why you're doing it is not to avoid tax, but to avoid medical negligence. Because as soon as you have independent doctors, if that doctor makes a mistake, it doesn't pull down everybody else because they're not your employees, they're not your contractors. So the main reason why people had service entities, which every lawyer and accountant I feel is missing the key point, was to avoid medico legal liability. It just happens to be an incidental benefit that you don't have to pay payroll tax and income tax, and you can income split legally and pay tax at 30 cents and 25 cents in the dollar. And if you do it properly, there's no reason. So to me, it's business as usual with our clients. Yeah, some people have got to get their details right, but it's about other things that we need to look at to take a closer look. So let's have a look at quickly some of those issues. Let's go to the next slide. And the thing is, people are saying, look, this whole thing, and there's actually $1 billion allocated in this year's budget a couple of weeks ago for ATO audits. The biggest area is they're looking at is small business, because small business is about 17 billion that in terms of tax avoidance that's going on, and it's only 3.6 billion on multinationals, but they'll tell you something different because we've got an election. But that's a lot of money. That's unprecedented. I've been doing this for 30 years and I've never seen so much money being allocated to the tax department. And interestingly, they've introduced these payroll tax exemptions is pretty much a way of self-incriminating yourself. So get proper advice. If you don't understand your structures, you really shouldn't be just filling out forms blindly and thinking it's okay and it's not clear. It's absolutely clear. If your accountant or your lawyer says it's not clear, I don't think they've probably done the research. And a lot of people, I believe, are paying payroll tax and volunteering unnecessary, but basically not understanding their structures and having it properly explained to them. And the other implication with that is, it's generally this problem we've had is generally it's because of poor taxation and accounting advice. And what's happening now, as of last year, we have to now dob in our colleagues. So the chance of getting caught, it's getting pretty high now. The stakes are high. The Labor government and the Liberal government are spending a lot of money, and the only way, and they don't want to increase taxes, the only way they do it is through tax enforcement, and that's what we're going to see. So we go to the next slide. Just so people have called me David Doom and I'm scaremongering. Here's the proof. I'm not making this stuff up here. Dob in provisions from the Tax Institute. Yes, us tax agents are devastated that we have to dob in our clients. They're telling us as of December last year, if we can't rely on software programs like even Xero and whatever, we have to check practice management systems that reconciliations happening. I know a lot of you practice managers know what I'm meaning. Reconciliations, it's not happening, and I know it's not happening. You have to make that work. And what they're saying here, they've allocated up to $50 million. So this is giving you the time frame, how much time you've got to clean things up. But the heat's going to start in 2026. So you've got basically 12 months to get your act together. And they're targeting high-risk tax practitioners who give poor and unlawful tax advice. And a lot of these rules have been written and have been basically the lawyers and the accountants aren't looking at it, because if you're not paying them a lot of money to look at this stuff, I can assure you it's probably not worth their while, and it's not their problem. It's actually yours, but it's not really an excuse. So basically, the
David, I think your mic stopped working. We can't hear you.
Sorry, David, your mic, I think, stopped working.
We can't still hear you, David.
so you can all hear me there, Jeff? Giving you some
Yep,
beautiful.
yep,
Sorry about that.
that's all good.
All right, we'll go to the next slide. Do apologise. So we're saying general practice is a high audit risk. And what we've done is we've actually written rulings both to the states and also the federal ATO, and Hamilton Bailey lawyers have actually put a legal opinion out there saying you won't attract payroll tax or income tax or superannuation if you have a genuine tenant doctor arrangement. By doing this, it does give people some protection. So there is solutions out there. So anybody who says there isn't, that's probably not true. You need to basically maybe ask the right people and they'll give you some sort of guidance. It is possible. We'll keep moving forward. And I did want to leave this a good news story. It's not the end of the world, but the threats are real. And the common mistakes that we're seeing with people who claim to have tenant doctor arrangements or are medical centres is incorrect advertising and completion of information. So advertising our doctors, or we're a healthcare practice, or hey, by the way, this is our fees and our set fees for the group. This is what gets you into trouble. That you're not. Each doctor should be listed. They should have their own independent websites. They should be seen to running their own business. Woolworths doesn't sort of advertise on Westfield's website. It's separate. Proda needs to show it's self-employed. It shouldn't have the name of the medical centre in the address. It needs to show that they are separate. If you're monitoring the billings of the doctors, it's fine to monitor service fees. But under a tenant, if you're basically monitoring the billings, you've basically got what are called contractor arrangements. These came out of a federal court case called the Helios case. It was $1 billion case that they lost an appeal in 2023, and that's why primary healthcare no longer exists, I guess. And that particular court case is being cited in all the payroll tax rulings. It's saying if you're a medical business, you either have employees and contractors, and therefore you have employee-like obligations from under the regulations. We're seeing financial statement errors where people are showing medical fees and they're showing that on their tax returns and their financial statements. These are big no-nos. If you're saying you're a tenant doctor arrangement, poorly drafted agreements, it's not enough to put one or two quick words and say super doesn't apply or delegation. They're looking at substance over form. They're looking at a multifactorial way. They've gone back to the old way, and certainly the Fair Work rules have got changed last year, that they're now looking at it more holistically and not looking at one or two clever words that a lawyer writes. And I think that's a bit of and that's what's causing a lot of these problems. People are saying, oh no, you can just get a clever contract and you're done. So be clear about your purpose. Be clear about that, you are running an administrative service entity and not a medical business. Make sure that the marketing perception is correct with websites. Make sure your processes are correct, that the phones are answering the doctor's name and not in the medical centre's name. And this has come from federal court cases. And make sure your people say, yeah, these are tenant doctors. They consult here. They should be the ones actually addressing complaints. It should be on their email address, not on the medical centre's email address. And this is common mistakes, and we've seen people have problems with that. And you're basically taking all your instructions from your practitioners. So the paperwork comes in when you've understood clearly these first 4 steps. Only then you get a lawyer who actually writes this up and can validate it. So therefore it walks the talk and you can provide that evidence. So let's keep moving forward here. The medical business model, this is where most people have actually got, where all the income from the patients goes to the medical centre, and everything else is bundled up and just sold as a medical business to patients. So you're selling medical services, and it's called a revenue share. You know, oh, we're doing a 70-30 split. This is probably what you want to avoid moving forward. This is a business model that was yesterday's business model. Moving forward, let's go to the next slide. This is really what you want as an administrative business, where you've got tenant doctors renting consulting rooms. The patient fees can be collected in what's called a quiz close trust, and we'll talk about that. That's centralized billing and receipting. It's a separate entity away from the service entity. And basically the practice support services, I guess we call it the pots and pans for the miners, that's what you're selling to the practitioners, who then on-sell everything back to the patient. So this is how you have what is called a tax compliant, where it doesn't attract additional payroll tax or superannuation obligations. Moving forward to the next slide. In terms of patient contact, this is just a workflow. Patients basically make their own appointments, and it's easy to do back. And they can make appointments online and under the doctor's name, not under the name of your medical centre. The website's very clear. It's got their ABN and their trading numbers all clear. The letterheads and tax invoices are all in the name of the practitioner, who is a sole trader. And then the service entity, when they answer the phone, we don't actually call them practice managers now. So the employment contracts, we've changed them with all our clients. They are called managers. They're receptionists, not medical receptionists. They're not practice managers. So it's really, really important these definitions are right, because they do, and we've been through payroll tax audits and won them, and particularly starting in Victoria back in 2014. And it's because a lot of this detail, when they looked at it, they said, okay, this is generally a separate support business. It's not one. This is not a business that it's just one medical clinic. It's actually a business that outsources support through to a service entity where they share the costs of running each individual practice. And bank reconciliations are really, really critical. They're looking at this, but how you collect the money, how you account for it on behalf, line by line, is critical. We keep moving forward. And just so people think, oh, is David making it up? This is approved by the ATO. It was approved in 2006 and 7. General practice is mentioned in it. The PIP payments go into your service entity. It doesn't go to the practitioner. It's all in there. And your lawyers and accountants should be totally aware of it. So we are going back to the future to these arrangements if you want to be tax compliant and tax friendly and not have a surprise with contractor arrangements. Quiz close arrangements, people say, oh, that's another furphy. David's made this thing up. No, there's a barrister's opinion, which happens to be actually the spouse of Chris Sievers, who was the lead barrister on the Super Optical and Dr. Thomas Naz case. So what you're going to be seeing here is there are actual proper legal ways to do things, and you can simplify your banking, improve your cash flows, and it's going to be the way you're used to doing things, but you just got to cross a few more T's and dot a few more I's to get it right, and you don't leave yourself open where doctors don't get paid. There's a way that practitioners can protect their income in case a practice does get done with a payroll tax audit, that it's protected, and that's a big recruitment selling point. We'll keep moving forward on that next point. And this is actually the legal and tax structure we've been using since 1992. Nothing's really changed. You have your service entity, you have a separate company that basically collects the money, and we'll give you the details later, but that's the screenshot. And all of this has a separate zero file to this, and this is the mistake people aren't doing. They're not having separate zero ledger for your fee collection entity that's separated from the service fee entity, and that's the reason why people get caught. And if you've got registrars, do not employ them in the service entity. You employ them as a separate entity. It's called like a partnership. If you've got more than 2 owners, you can be the sole owner. If the sole owner is a GP, you can do the supervision, and you have a proper service agreement with each of your tenant doctors. All the money that the patients have goes directly into their quiz close entity. Then the service fee split 70-30. It's all pre-authorized with a service agreement, because you need legal authority. Banks can't just take money out. Otherwise, that's called fraud. And basically the money gets swept. The doctor's pay calculator program automates this entire process, so it's not so much a big deal. But that money automatically gets swept, the right amount of money into the service entity, the net amount back to the tenant doctor. So these things that we've got clients doing it. It's not kind of, a beta thing. This is just what's happening in reality, and you can do that, not have all these tax problems that others are experiencing. Let's move forward to the next slide, but maybe show that to your accountant. This actually, I'm not going to go into the details, but people have been running off and doing separate banking, thinking it's a great idea. It's the worst thing you could do from from Medicare fraud, bank reconciliations, and cash flow problems. We just don't recommend it. What we recommend is what we've recommended before. It's actually option 3, quizflow account. The biggest mistake people are doing at the moment, they're running clearing accounts in their own medical centre, thinking a separate bank account within the medical centre's bank accounts, where they'd have two. They'd have one to pay, let's say, the receptionist, and another bank account to collect the fees. The reason why you're getting caught is the ABN and the tax file number is linked to the same bank account. And that's what the judge was referring to. There was no separation of that bank account in terms of ownership and control. So if you do that properly, you can actually get around that particular problem. But you need a proper service agreement. You have to have, there's certain rules with quizflows arrangements that you need to have where all parties are quite clear about that arrangement. So option 3 is the one we've been using, and we've been using it for decades. It's not something that we just, created, because there was a major payroll tax problem. Let's keep moving forward.
Great stuff. David, just conscious of time as well.
Oh, okay, that's right. I think we've finished here. These are things that you can look at your own leisure. So we'll just keep moving forward. I think we've nearly come to the end. We'll talk about mezzanine equity for those later for recruitment retention, but there's opportunities there where people can earn while they sleep, and that's really good when you're a young doctor. If they bring in another young doctor, they can get a share of the profits that are made by bringing in other young doctors. But we'll talk about that another day, maybe, Jeff. So we'll keep going. Where to from here? Just be clear that these are the 5 key checkpoints you need to do now if you think you've got a problem. We'll go to the next slide. If you need if you need to convince yourself or other doctors why it's good, well, the main benefit, you don't have to increase, have a payroll tax admin fee, which is not quite legal. I don't know how practices are getting away with double tap and all these wonderful words. It's going to improve your cash flows, efficiencies. It's going to give people more tax benefits, and it's going to give them better asset protection. If you need more information, take a picture of this. That will deep dive into some key areas that you might need to know. There's a free assessment. It's confidential. If you want to know more about all these other things, just look us up with that. So we do tenant doctor certification for lawyers and accountants, so you don't have to come across as, move all your work to us. But we're here basically to help everyone out. So thank you very much, Jeff. And I'll let you kick on, and then if there's time for Q&A, we'll go from there.
I want to take a moment to sincerely thank you, David, for an incredible insight today, especially around the tenant doctor agreement and around the risks as well as opportunities for general practice. So really do appreciate it. Now, for us, I would love to dive deeper down the rabbit hole in terms of structuring your practice for maximum profitability. At HealthView, we work with practices right across Australia, and when it comes to improving profitability, these are the 3 controls that make the biggest impact. Number 1, understanding your revenue stream. First, you need to completely grasp where your income is truly coming from. Are you billing all eligible MBS item numbers efficiently and consistently? Are your PIPs and WIPs completely optimized and tracked quarterly? Have you recently reviewed, or are you reviewing your pathology agreements and other health services agreement to unlock more margins? Most practices we speak to are leaving money on the table, not because they don't work hard, but just because they don't have the structure in place to fully support these revenue streams. Knowing your benchmark is extremely important. It's not enough to keep track of your revenue. You need to benchmark against national GP average. Practices that are in similar size, such as yourself. What are some of these benchmarks? Well, we discussed today 246,349 in service entity revenue per full-time equivalent, which is around $63,000 in consultation room profit. However, we also track your CDM billing. A high-performing practice will generate $6,000 to $10,000 per GP per month in CDM item numbers alone. It's not just about the volume, it's about the ratio. So we've marked down here an example. You see 2 to 3 times more 732 reviews than your 721s and 723 plans. And do not overlook your 10,997 item numbers. These are very much often underutilized items, and they are great revenue opportunities when you look at your active patient database. as you can bill this item number 3 to 5 times per year. And lastly, implement a best practice to boost CDMs. To maximize CDM income, you need a strong system, repeatable system that is structured, nurse-led with workflows, with an appropriate billing audit system in place to ensure accuracy and prevent compliance risk. The key takeaway here is very simple. When you align a structure with an opportunity, profitability will follow. We have a revenue boost assessment that will map this out for your practice and give you the exact steps to start capturing what you've been missing. I would like to move on to common CDM item numbers and is really just a refresher for everyone. So when it comes to building a profitable CDM workflow within your practice, it starts with mastering these core MBS item numbers. So your 721s, you can bill every 12 months. Your 723 every 12 months as well. 732s, 3 to 6 months. Ideally, we're seeing 2 to 3 times more 732s than new plans. Your 729/731 is often every 3 months when you're collaborating with teams, I guess, across care teams. And finally, your 10,997. This one is really a game changer we found because you can bill this obviously 5 times a year and it keeps your nurse active with the continuity of care for your patients. When these are structured right, you're not only improving patient outcome, you are unlocking a significant reoccurring revenue within your practice. This is exactly the kind of workflow we look at to optimize revenue within your practice. And it is a part of our revenue boost assessment that we can look at opportunities and missed opportunities within your practice. So how should you structure your CDM workflows for real impact? Now, implementing a CDM workflow is not just about billing item numbers. It's really about building a robust system that's repeatable and manageable. To walk you through some of these, a high-performing practice in terms of what they do, they set and outline a patient identification and eligibility check. So your automated recall systems, they make sure that's you're completely on top of that, along with setting up alerts within your patient file. Moving on to setting up, I guess, care plan scheduling and time allocation is very important. So blocking a portion of time for your nursing staff, typically around 30 minutes, as well as your GPs to prep for the prep and the consultation. This also means ensuring that your nurses are trained and there is time effectively allocated to also complete your 10,997 item number for follow-up to follow this up effectively. Moving on to team-based coordination, the best CDM systems we've seen are nurse-led. The nurses prep the plan with a structured template. Admin staff then manage the reviews and manage the reminders and the booking. And the GP then completes the review, approves, and finalizes the care plan. This is a team-based effort. It's not just one person. Followed on with reviews and follow-ups. Schedule your 732 reviews 3 to 6 months at the time of the original plan. Then use your 10,997 nurse in between these care plans for active patients. Finally, a big one, the documentation and compliance, especially now with all the changes that are happening. This is where many practices are slipping up. Proper documentation that aligns with the MBS descriptors, plus a signed consent form, especially around your TCA claims. When all these pillars are placed, you have a very powerful CDM driver within your practice that delivers outcome and reoccurring revenue. And that's exactly where we help you and build this out for you. With our revenue boost assessment, we can review how your process flow, what your process looks like, and how we can optimize that. Moving on to revenue drivers for maximum profitability. I would like to zoom out and look at these three major revenue drivers we focus on to lift your practice profitability and sustainability. These are areas where we see the biggest wins across Australian practices. The first and most obvious, your MBS item revenue, especially now with the additional incentive. It's not just item numbers, but it's the training of your staff on usage and improving your workflows. Many practices underbill CDM item numbers as well as after hours item numbers simply because staff aren't confident when or how to use them. We help you with regular audits, regular training, and ensuring that education is available for your team. The goal is simple: bill accurately, reduce leakage, and staying compliant. When it comes to your PIPs and WIP incentives, there's so many times I've walked into a practice thinking they think they're optimizing on all their incentive, but it's not until we complete our assessment where there is opportunities. We ensure that you are fully eligible across all your incentive and that you're correctly registered for these incentives. That includes keeping Proto up to date, ensuring the submissions are completed on time. Then we review your incentives and see where we can implement our incentive blocks, so you're never missing out on a claim and ensuring your cash flow stays healthy. Finally, a big one we've actually seen very often in the last few years, your pathology agreements and other health services. We review your pathology agreements to make sure you're getting the most competitive, compliant terms. But we also help you co-locate health services such as allied health, skin, to expand your revenue stream and diversify your revenue stream within your practice. In our revenue boost assessment, we will audit your MBS item numbers and find opportunities, as well as your PIPs and WIPs incentives, to show you exactly where the leaks are and how we can fix them. Let's get paid for the care you deliver. This is one of the most important mindset shifts we help practices make. You are already delivering on the care, so let's make sure now you are getting paid for it. This starts with a focused MBS strategy, conducting MBS utilization audits, reviewing missed item numbers within your practice. We often find that GPs are underbilling not because of the lack of effort, but because of the lack of visibility or the use of the data within your practice. You use tools such as Cubico, Pencat, Polar, but how is this data translated? Our audit pinpoints item numbers that are missed and even break down doctors or sessions so you know where you should be focused on. Number two, promoting a structured CDM, chronic disease management. CDM is a huge, huge revenue lever. We ensure that your team is consistently using your item numbers such as your 721s, 723s, and tying that into your PIP-QI metrics, not only improving cash flow, but also improving care. This is about making CDM a system, not just a once-a-year event. Leveraging preventative healthcare item numbers, such as health assessments, 701, 703s, mental health care plan. These are often underutilized item numbers, but are high in value. Using templates and perfecting those templates within your practice. The removal of guessing work and helping doctors stay compliant while ensuring they don't miss out on billing opportunities. The amount of times I've worked with doctors where they were afraid to do a care plan because they didn't want to be audited. And then when we completed an assessment, they were actually sitting at 2% of their CDMs or 3% on of their CDM across the total billings. Prompt link back to clinical notes and create a clear audit trail, protecting your practice, making life easier for yourself and your team. This isn't just about billing more, this is about billing smarter, ethically, and more efficient. And our revenue boost assessment is where we start to build this out for you. My favorite topic is around your incentives, your PIPs, your WIPs. Practice overlook incentives. They believe it's once a quarter money that comes in, and it's predictable, recurring income stream. But too many practices are missing out. There are many. Oh, excuse me. There are many, obviously, incentives within that are available to practice, but optimizing those incentives, different levels, different workflows will ensure that you are maximizing on all incentives. Your workforce incentives, obviously, it's based on your nurses and allied health. So what does the strategy look like when it comes to your incentives as a whole? Regular audits, updates, ensuring Proto is up to date. Your statements are submitted, so you're not missing out on payments or delayed payments, and aligning clinical activities with the correct incentive trigger. By optimizing your MBS, your CDM, billing smarter with the quality of care, that actually has a direct impact to your incentives, your SWIP account, and document everything, particularly when it comes to team-based care arrangements. We run a revenue boost assessment. We look at exactly these areas. We audit your eligibility, clean up your records, and put a system in place to make sure you are capturing on every dollar. It's one of the fastest ways we boost cash flow and build financial resilience within your practice. Now, bringing this all together, let me ask you one thing before we wrap up. And truly ask this because it's extremely important. Are you confident that your practice is capturing on every dollar you deserve when it comes to your MBS, when it comes to your incentive? Because here's what we see across Australia. Even the best run clinics are leaving money on the table, tens of thousands of dollars, not because they're doing anything wrong, but because they don't have a structure in place for visibility or a strategy to turn care into consistent revenue. We built a revenue boost assessment to fix that. This is not a sales call. It's not a freebie with fluff. It's a focused session designed to find real value fast. Here's what you will walk away with. We will identify opportunities within your MBS, highlight the opportunities within your incentive, and a clear roadmap to boost revenue without adding pressure to GPs. If you're serious about protecting your business and thriving in 2025, scan the QR code now. It'll take 10. I'll give you about 10 seconds to book in your time. In this one session, I will promise you'll know exactly what are your financial wins within your practice. This is your power up moment. More than happy to give you another quick 5 seconds, and we will be moving on to Q&As. I really appreciate thank you for all your time, and yeah, let's power up your practice together.